Good afternoon, everyone. I'm Charles Payne, and this is Making Money. You know, interesting. Bloomberg kicked off the week yesterday with a headline that sounds like all of the headlines for 2025, right? Imminent correction, stocks about to drop. Ooh. Of course, the market hasn't obliged any of these, right, calls. And I've been calling this really the summer stroll. Not, of course, to be confused with the summer doldrums. No, right now the market is just drifting. The summer doldrums, normally you see the market drift lower. Typically in light volume, all the big guns hanging out in the Hamptons or Aspen, something like that. But this summer, this market has drifted higher, right? This after that massive V-shaped monster bounce that maybe should have invited some consolidation. But save for that flush on Friday, it's been really nice and steady. Each step, however, lifts the market well above Wall Street's consensus. Now the street is warning, just like they have all year long, of a pullback. You know, what's really interesting about this, though, is the Morgan Stanley, Deutsche Bank, Evercore, they're not looking for massive pullbacks, 10%, maybe 15%. And what's odd about it, though, is that some of them are talking about tariffs, right, as the reason for this. But let's face it, this impending summer swoon is not unusual if it does happen. This is the typical late August, September, even going into October. For the last 5, 10, 15 years, normally we do sort of have pullbacks, right? So let's face it, pullbacks, corrections, they occur frequently, all the time. And so let's call it seasonal if it does happen. And you could pinpoint it to tariffs, but really seasonal if it happens. It may not, though, because a month ago, I can tell you, many were actually pointing to Barclays. They have this irrational index, exuberance index, and it has spiked up, and it was looking really frothy, right? Irrational exuberance gauge sparks fresh bubble worries. Well, the names mentioned in the Bloomberg piece are not talking about the end of the world, so I'll give them that much credit. I do find it, though, somewhat worrisome to see the fixation of the foremost Wall Street strategists out there. Just so much small, like minute nuance, right? They're looking at these short-term moves for the next week or so. That's not what they used to do. In the meantime, the stock market is doing things that normally don't happen when it's irrational, when there's irrational exuberance. For instance, companies that are missing earnings are paying a heavy price for it. 5.6, the historic average is 2.4. This is not irrational. If we were irrational, stocks would go up no matter what, but particularly on beats. Also, the fear that we've had a few days ago, last week, this IPO mania, no one wants to see it get where it was. That was tamped down a lot yesterday. Remember that sizzling debut by Figma? It was like the best IPO maybe in a decade, something like that. Well, going into yesterday's session, it's at the very top here. Figma, these are all your tech companies, the forward PE ratio. It had the highest one out of all of them, 602 forward PE. It was down 27% yesterday. So there was some rationality. They smacked the stock down. So perhaps the market is not as insane as some would hope or like to portray it as. By the way, there are a lot of names on this list that do have higher than average market valuations, in part because they've earned it. Instead of fighting this thing, maybe we should just marvel at the majesty of it all.